My name is Muhammad Zahid. I am teaching for the last 20 years in nationally or internationally, different schools and at the college as well. Now I am giving a lecture on Introduction of Accounting, O-level accounting 7110. This is the code. So let us start. This is the very basic definition of accounting, what view and where it starts. The definition itself will say where the accounting is starting and how the accounting goes. Itself is telling how the accounting starts and where it goes. So the first condition for the accounting is transaction. And this transaction is business transaction. This is the transaction is the first step of accounting. In every questions you will have transactions, and from the transactions we prepare the books. Come to next, what is the sale is what is transaction? The transaction means at one time we are business is giving and taking the something is giving and taking something at the same time. This is called transaction. Okay, so transaction means give and take on the same at the same time. At the same time, give and take at the same time. For example, if we go to shop or any other place, we pay money and we buy the goods, we take the goods. So actually we buy. So how we buy? We pay the money and we take the goods. So this is our transaction. Like this also happen in the business. So transactions are two types. Number one, cash transaction. Okay. When we pay money and take the goods, this type of transaction is called when the business pay money and take the goods or resources, that is called cash transaction. The next one is credit transaction. Credit transaction means that money is not paying at the same time. The money is supposed or is decided to pay after some time. It is decided between the buyer and seller. After 1 day, after 2 days, after 15 days, after 1 month. That is called credit transaction. So these two type of transaction, after transaction, we write in the these transactions are recorded in the books. That this activity recording in the books is called bookkeeping. The next step is bookkeeping, recording or writing transaction, recording or writing transaction in the books of accounts, in the books of accounts, in the books of accounts is called bookkeeping. So bookkeeping is the first stage of accounting. Without bookkeeping, we cannot make accounting. So this is the first stage of accounting. First we complete the books, then we are making accounting. After accounting, recording the books in the transaction, what are the things? So this much, what are the things we do? We make the accounting is the upper stage where we prepare. So I am writing, I am rubbing these things. Now I am writing the next. What is the things? Okay, here I am writing accounting. interpreting the results. What we do, we in accounting, the accountant prepares the accountant the accountant prepares the final accounts, fine final stay financial prepare the financial prepare fi, prepare prepare financial statements. Okay, dear, financial state financial statements. Okay. Fine. And this, so what is the things? The first thing is transactions. What kind of transaction? Just I am repeating. What kind of transaction? Transaction of monetary value, which should be written in terms of money. It should denote. So give and take. Okay. Take. So accounting it prepares. Accounting means accountant prepares financial statements. So financial statements are normally income statement, income income statement and balance sheet. Okay. Now the thing is that how we, what is the basic formula? This is the end of the accounting. I am coming to my point. First we have written the first we have given the transaction. From transaction we have prepared the books. After books we are making, after completing the books we prepare the financial statements. Now I am coming to the point, what is the basic formula of accounting? What is the formula of accounting? The formula for accounting formula of accounting, formula of accounting is assets is equal to liabilities plus capital. This is assets, liabilities, and capital. This is called double entry bookkeeping. What is the meaning of double entry bookkeeping? For every debit, there is a credit. For every credit, there is a debit. So, this is called our double entry bookkeeping. First, we have to know the formula of accounting is this: assets, liabilities, and capital. Let us know what is assets. In theory, the assets are the resources of business. Now, come to the point. If anybody is opening a business, who will provide the money to the business? Obviously and very clearly, the owner will provide the capital for the business. So that's why resources are the assets. First the owner will provide the money which is given by owner, it is called capital. So I am writing a simple definition, a very simple definition for these items: assets, liabilities, and capital. Asset means the resources of the business. Okay, so the assets are normally two types: current assets and fixed asset. Current assets, for a current assets, the example of current asset is, I am giving the example. The example of current asset is cash, okay, cash, account receivable, inventory, okay. The fixed assets, how defined? The current assets are those assets which are changes very frequently, normally in a day, in a week, or within a year. Fixed assets are those assets which are supposed that they are not changed within a year. They have life more than the 1 year. Those are called fixed assets. For example, building, furniture, and computer. These are the example of fixed asset which have a long life more than the 1 year. These are liability is the money, liability is the money business owe, liability is the money business owe to pay to outsiders. Money to pay to outsiders. Money pay to outsiders. This is called liability. Capital, money invested by the owner. Money invested by the owner is a capital. Money invested by the owner is a capital. Clear? So these are the basic formula. Now I am extending this formula. Okay. Now what we know how what is transaction. Now we know what is bookkeeping. So now I am coming. Now we know what is the basic formula. So this formula is double entry bookkeeping. For every asset, for every debit there is a credit. For every credit there is debit. So this is the basic formula. And what is assets? Assets are the resources of business, and these are two types. Current assets, these are the example. Fixed assets is here example. Liabilities, money pay to outsiders. Money business pay to outsiders, these are the called liabilities. And capital is the money invested by the owner into the business is called capital. Clear? Now, how we can, the question is how, now I am extending, how we can transfer these transactions into accounting. In the items, we apply the formula of debit and credit. Now what I am doing, before going the next stage, I am expanding this formula for your understanding. Okay. Okay, expanding this formula. So what is happening? The next expansion. Expansion. What is that? Assets is equal to liabilities, liabilities, okay, plus capital plus profit minus expense. So you already know, we already know what is liabilities, what is assets, what is liabilities, what is capital, profit minus expense. So these two things are new for us. So expense are the benefits we are have we are having business facilities to make the profit. So when we are having the benefit, we are using the benefits for making profit. These benefits are normally, these expense are, example of expense are rent, salaries, electricity. Okay, so rent, salaries, electricity. These are the example of expense. So at the moment we are having expanded form of accounting. Next stage of formula. Next, expanded form. This is the expanded form. All the items have come here. Now we have some terminologies which we have to make clear. We have some terminologies which are we have to make very clear. We have to make it clear before applying the debit and credit rule. Do those technology. Now I am rubbing this one because no need for this one anymore here. Okay, so I am repeating again. Number one, assets. Assets are the resources of business. Assets are the resources. Assets are the resources of business. Okay. Assets are two types. Number A, current assets. Number B, fixed assets. Okay. Now what we have, liability. Number two is liability. O, to pay to outsiders. This is called liability. Then capital, number three. Capital invested. Capital means money. Capital means money invested by owner. Money invested by owner into business. Then we have number four, we have expenses. Expenses are facilities. Business has taken the benefits benefits to earn profit. Business has taken benefits to earn profit. This then the last one is revenue. Revenue means money received, RECEIVED, received from customer. So this is our, now we are completed the very basic things about the accounting, and these terminologies, these are the five called elements. These are called the elements of accounting. Okay, so we have to learn by definition. We have to very clear about these definitions. In the next, we will apply the debit and credit rule on the transactions, and we will convert that transactions into accounting. We will write in the books of accounting by using the debit and credit rule. So first, today we are finishing at the elements of our accounting, how we can convert. So these are, you have to learn these things by definitions. Assets are the resources of business, current assets and fixed assets. Business owe to pay to others, this is called liability. Capital means money invested by owner into business. Business has taken benefits to earn profit. So business has taken earned business profits. It is called expense. Thank you very much.